Welcome to FinBot Insights, your go-to channel for clear, no-nonsense financial education. Today, we're diving into a hot topic from the Bogleheads community on Reddit: why hold bonds in your portfolio? This question sparked a lively discussion on the Bogleheads subreddit, and we're going to break it down, add some insights, and explain why bonds might still have a place in your investment strategy, even if you're young or have a long time horizon. So let's get started. First, let's set the stage. The Bogleheads, for those new here, are a community of investors who follow the philosophy of Jack Bogle, the founder of Vanguard. Their mantra: invest in low-cost, broad market index funds, diversify between stocks and bonds, buy, hold, and stay the course. But a recent Reddit post titled "I Still Don't Understand Why Hold Bonds" got a lot of attention. The poster, like many younger investors, questioned why anyone, especially those with decades until retirement, should hold bonds when stocks historically offer higher returns. It's a fair question, and the 154 comments and votes show it's a debate worth having. The core argument in the post is this: if you're not planning to withdraw money for decades, why not go all in on stocks? Broad-based ETFs like VOO or VTI have historically outperformed bonds over long periods, averaging about 10% annual returns compared to bonds 5% or so. So why dilute your portfolio with bonds and potentially miss out on growth? The poster even admitted to feeling more anxiety about missing market gains than enduring market downturns. Sound familiar? Let's unpack the reasons bonds are still a cornerstone of the Boglehead philosophy and why they might matter for you. Reason 1: bonds reduce volatility and act as portfolio ballast. One of the main reasons Bogleheads advocate for bonds is their role in reducing portfolio volatility. Stocks can be a wild ride. Think of the dot-com crash, the 2008 financial crisis, or even the sharp dips in 2022. A 100% stock portfolio might drop 50% in a bad year, which can test even the steeliest investors' resolve. Bonds, especially high-quality ones like US Treasuries, tend to be less volatile and can act as a cushion. For example, a 90/10 stock-to-bond portfolio might only lose 35% in a crash instead of 50%. That's a big difference psychologically. In the Reddit thread, one commenter pointed out that many investors overestimate their ability to hold strong during a market crash. They referenced daily threads from a month prior when a 10% market drop had some Bogleheads panicking and considering selling. Bonds can help you sleep better at night by smoothing out those scary dips. Even if you're young, a small bond allocation, like 10%, can make downturns feel less catastrophic, reducing the urge to panic sell at the worst possible time. Reason 2: diversification and risk-adjusted returns. Here's where the Boglehead philosophy shines. It's not just about chasing the highest returns, it's about maximizing risk-adjusted returns. A commenter in the thread used a great analogy. A 100% stock portfolio might aim for a 6% real return but come with, say, 90 risk units. A portfolio with 40% bonds might target a 5% return but with only 30 risk units. The bond-heavy portfolio sacrifices a bit of return for a lot less risk, making it more reliable over time. This ties into diversification. Bonds, especially government bonds, often have a low or negative correlation with stocks. This means when stocks tank, bonds might hold steady or even rise in value. For instance, during the early 2020 COVID crash, while stocks plummeted, long-term treasuries gained value as investors flocked to safety. A 2023 Reddit post noted that bonds provided a cushion during the January to April period that year, proving their worth as a diversifier. Diversification isn't about predicting the future, it's about preparing for uncertainty. Reason 3: sequence of returns risk. Let's talk about sequence of returns risk, a concept that popped up in the Reddit discussion. This is especially relevant if you're nearing retirement or planning to withdraw funds in the next 5 to 10 years. Imagine you retire just as the market crashes. If your portfolio is 100% stocks, a 50% drop could force you to sell at a loss to cover living expenses, depleting your nest egg faster than planned. Bonds provide a buffer, giving you a stable asset to draw from during downturns, so you don't have to sell stocks at a bad time. Even for younger investors, this matters if you're saving for goals like a house down payment or a child's college fund. A 2023 Reddit post emphasized that bonds are critical for shorter-term goals, less than 10 years, because they reduce the chance of a big loss right when you need the money. A 100% stock portfolio might be fine for a 30-year horizon, but for shorter timelines, bonds add predictability. Reason 4: bonds aren't always a drag on returns. A common misconception is that bonds always underperform stocks. While stocks have historically outpaced bonds over long periods, there have been times when bonds shone. A 2022 Reddit post noted that from 2000 to 2010, bonds outperformed stocks due to the dot-com crash and the financial crisis. Over the long term, from 1793 to now, bonds have outperformed stocks about one-third of the time in 30-year periods. That's not to say you should go all in on bonds, but it shows they're not just dead weight. Plus, bonds can generate income. If interest rates rise, new bonds in a fund like BND Vanguard's Total Bond Market ETF will have higher yields, boosting your returns over time. A 2023 comment mentioned that rising rates mean bond funds cycle in higher-yielding bonds, which is great for long-term holders. So bonds aren't just about safety, they can contribute to your portfolio's growth too. Reason 5: Behavioral benefits and avoiding FOMO. Let's get real, investing is as much about psychology as it is about numbers. The Reddit poster admitted to feeling more FOMO, fear of missing out, about market gains than fear of losses. That's common, especially in a bull market like we've seen in recent years. But as another commenter pointed out, FOMO can lead to risky moves, like ditching bonds entirely to chase stock gains. The Boglehead philosophy is about discipline, not chasing trends. Holding some bonds forces you to stick to a plan, which can prevent impulsive decisions. Jack Bogle himself recommended never having less than 20% in bonds, even for young investors, and Benjamin Graham, the father of value investing, suggested a 25% minimum. These guidelines exist because even the best investors can't predict market crashes. Bonds give you a safety net, so you're less likely to derail your long-term plan when the market gets ugly. Counterarguments: why some skip bonds. Now let's address the other side. The Reddit post argued that for long-term investors, say 20 or 30 years from retirement, stocks almost always outperform bonds. A 2024 post echoed this, stating that a 100% stock portfolio is optimal for those who can stomach the volatility. If you're in your 20s, have a high income, and can keep investing through crashes, the math supports going heavy on stocks. After all, every dollar in bonds is a dollar not growing at 10%. Some commenters also pointed out that high-yield savings accounts or seeds can sometimes offer better returns than bonds, especially when rates are high, like in 2023. These alternatives can act as a bond substitute for short-term needs. However, unlike bonds, savings accounts don't offer the same diversification benefits, and their rates can drop quickly if the Fed cuts rates. How much bonds should you hold? So how do you decide on your bond allocation? It depends on your risk tolerance, time horizon, and goals. Here are some Boglehead-inspired guidelines. Young investors, 20s, 30s, 0 to 20% bonds. If you're comfortable with risk, a 100% stock portfolio or a small 10% bond allocation, like in a 90/10 portfolio, can work. Consider treasuries or a total bond fund like BND for simplicity. Mid-career, 40s, 50s, 20 to 40% bonds. As you approach retirement, increase bonds to reduce volatility. A 2024 Reddit post suggested looking at target date fund glide paths, which often start at 10 to 20% bonds for those in their 40s. Near or in retirement, 40 to 60% bonds. This protects against sequence of returns risk and provides income. A 2023 post recommended treasuries, TIPS, or municipal bonds for tax efficiency. For most investors, a simple total bond market fund like BND or a treasury fund like GOVT is a solid choice. If you're in a high tax bracket, consider municipal bonds like VTEB for tax-free income. The key is to pick a bond fund, set your allocation, and stick with it, no market timing. Finbot's take: bonds are your portfolio's seatbelt. Here's my take: bonds are like a seatbelt in your investment car. You might not need them most of the time, but when you hit a rough patch, they can save you from a world of hurt. Even for young investors, a small bond allocation, say 10%, can provide peace of mind without sacrificing too much growth. The Reddit discussion showed that even die-hard Bogleheads can disagree, but the core principle of diversification holds true. Stocks drive growth, but bonds keep you steady. If you're still skeptical, try backtesting. A 2024 Reddit post shared that a 90/10 portfolio had a 97.7% success rate over 86 30-year periods, nearly matching a 100% stock portfolio's upside, but with better downside protection. Tools like Portfolio Visualizer can help you see how bonds affect your specific plan. Wrapping up. So why hold bonds? They reduce volatility, diversify your portfolio, protect against sequence of returns risk, and help you stay disciplined. Even if you're young and tempted to go 100% stocks, a small bond allocation can make your journey smoother. The Boglehead philosophy isn't about maximizing returns at all costs. It's about building wealth you can rely on no matter what the market throws at you. What's your take on bonds? Are you team 100% stocks, or do you see value in a balanced approach? Drop a comment below and let's keep the conversation going. If you found this video helpful, hit that like button, subscribe to FinBot Insights, and ring the bell for more practical investing tips. Stay the course, and we'll see you in the next one.